Wow, just ended there. Hey guys, welcome back. Jeb Smith, real estate broker here in Southern California. We had a guest, but he seemed to have left the room. Josh, who is
Your music ran me off, Jeb.
fair enough. Certified mortgage broker. We're here to answer your questions regarding the housing market, real estate market, anything mortgage related. We might be here to just get things off our chest. If something's bothering Josh about his wife, we use this channel to express those feelings and just lay them out there.
We'll invite her on. She can give you the long list of things that she's unhappy with me about, but we would never.
Bro, we don't have the show is only 2 hours. We don't have enough time for that. So
my wife is an angel and a gift from God. There would never be a list.
On his side, that is correct. On her side, I'm sure there is one, but nevertheless, we appreciate you guys being here. Thanks for joining us. We are going to start today by just talking about some recent news that came out today, right? We had the Fed met earlier today. They changed their stance a little bit, which we'll let Josh talk about here in just a minute. We also got some data on existing home sales, which, more or less went along with, I think, what was expected out there to some extent. We did see a 2% decline in existing home sales. Existing home sales are sales that have actually, closed escrow, right? They're properties that have closed. And based on what's happened over the last couple of months, we've seen buyer demand kind of drop a little bit. We're in the middle of summer, right? People are taking vacations. The kids are going back to school in August, or most of August and September in a lot of places. And so you had people leave, right? That's probably one reason that you saw a decline. People doing their last minute vacations. Some markets, people are priced out. You've got, you got a lot of different factors going on. So the fact that you saw a 2% decline, I don't think is really anything to worry about, Josh. And we've talked about understand where that 2% decline is coming from, right? It's not like we've seen, a 15% decline the month prior and a 20% decline, and we saw a 2%. It's, this is really 1s and 2% is really all we've seen at this point.
Well, one of the things we talk about regularly and repeatedly here, double-digit annual inflation in home prices is not sustainable and not healthy. So instead of being sensationalistic and publishing headlines, cracks finally seen in market finally trending down. Yeah, it's trending down because it needed to. We had a couple of months. If you guys were here watching back in February and March, Jeb and I had tears running down our faces from writing offer after offer with 40 other offers that we were losing out to because the market was so hot. If you're seeing some of the moderation is coming from those months like March and April when all of those crazy sales from January and February started closing. We're coming off of the previous year when the market really slowed and shut down and didn't dip, but kind of flattened as there weren't many transactions going that were at higher points. So now that we're getting that super big bubble out and adding on some of the months from later last year, August, soon to be September, we're going to see much more stable month-over-month numbers. So the last few monthly readings we've seen on all of the indexes, whether it's Case-Shiller, FHFA, Zillow, they all run their own little indexes, and they were saying 16, 18% year-over-year appreciation. It's moderating down into that 15% range, but long way of saying exactly what Jeb said. This is healthy. We want the market to slow down. It doesn't mean it's slow. It's always going to come back to supply and demand. We have a constrained supply, large demand for homes. So home prices are going to continue going up. We all want them to go up at a much slower rate. So instead of panicking or celebrating and saying, see, in 3 more months, they're going to be negative and I can jump in when the market crashes, we just need to look and understand what this is. It's a moderating to hopefully a more sustainable number that doesn't keep so many people blocked out of the market.
No, and there's a couple things in that report. Instead of talking about existing home sales and just doing a video on existing home sales, there are people out there that are going to do that, and you can get the information from them. But I'm just going to run over a couple of the highlights that I think people want to know in here, right? So what percentage are still cash sales? 22% of the sales in August were cash sales. That's down from 23% in July. So it dropped 1%, from July to August, but it's up from 2020. August of 2020 was at 18%. So there's still a big percentage of people out there buying homes in cash. First-time home buyers made up 29% of the market. Individual investors, second home buyers purchased 15% of the homes. And so, it's still, things are still moving along, guys. We're not seeing a lot really change in the market. And I did a video earlier in the week where I talked about, and I think it's really, really important to stress this because I know a lot of you guys are watching from all over the country. And Josh, and I were talking about this prior to the show. Real estate is local, right? When I talk real estate, 99% of the time, I am talking Southern California real estate. I'm telling you what's happening in my market. I'm in a bubble, so to speak, and not a bubble in the way that you're thinking of it, not a housing bubble. I'm in a bubble of Orange County, right? There's a lot of money here. We didn't see a lot of the effects of some of the markets from last year other than strains on housing and that sort of thing, right? Unemployment isn't really a big problem in my market. So when I talk housing, I'm primarily talking here. Now, I take a lot of the national numbers and help you understand what they mean. But if you're in a market and you're seeing something entirely different than what I'm talking about, that's possible. But again, even here, when we mention the major markets, we have people reach out from smaller markets all across the U.S. saying, hey, listen, I'm putting in offers. I'm seeing the same thing. But just keep in mind, when you're talking to an agent, you're writing offers, it's local. Just understand what's happening in your market and less concerned about what's happening nationwide. But Josh, Fed met today. You want to give us a little update on their stance or thoughts on the next couple of months with regards to their statement taken into account?
There wasn't a big change in the statement. The big thing they came out with and said, so they've been, since the middle of last year, buying $40 billion a month of mortgage-backed securities and $80 billion a month of U.S. Treasuries. So mostly what the big change was, they said they're going to taper slowly and be completely out of their bond buying, both mortgages and treasuries, by the middle of next year. So they didn't say June, they didn't say July, they said the middle of next year. And they also didn't say when they're going to start. So the market's known it's coming. The market didn't really get super concerned about it. When I say the market, interest rates were slightly improved this morning. Not in terms of the interest rate improving, but the price you would pay. What would have been 0 points yesterday would have this morning given you about a 15 basis point lender credit, a 0.15% lender credit. Well, the Fed makes this announcement, market kind of knee jerks and goes the other direction, and you would have paid about 0.25% more for what would have been a 0 point loan yesterday. By the end of the day, we ended up exactly where we started the day. So the markets looked at what the Fed said, that, hey, we're going to stop buying mortgage-backed securities sometime soon, and we're going to completely stop buying them by the middle of next year. So most likely what you're seeing, there's $40 billion a month. My guess would be they reduce them by $5 billion per month over the next 8 months or so. Start in November, you're done by June. And the markets, the Fed has done, from this perspective, a good job of telegraphing, we're going to start sometime late in the year, we'll be done by the middle of next year. They gave themselves a little bit of wiggle room and then out by saying, hey, we don't really know how COVID and the Delta variant is affecting everything right now, but they said we're close to full employment. Market shocks are mostly gone, and we're going to taper and back out of the market. So from an interest rate perspective, I don't expect there's going to be a huge difference based off of what we saw today, and more importantly, what we've seen over the last 2 to 3 months. The markets have gone almost nowhere. So on day-to-day changes, your entire range of interest rates in the last 3 months has been less than 0.25%. That's an incredibly stable market, and we're likely to stay there through the end of the year until we get some sort of more information that tells us what's the direction of everything going forward. If the economy heats up, if inflation stays higher longer than people expect, maybe they'll trend up a little bit. But I think over time we're going to see the opposite. The economy is going to be cooler than most folks think. Inflation's going to moderate, and it's going to lead to long-term low interest rates.
Yeah, and I think it's important to note too that, in today's meeting, when they mentioned, I guess 9 of the 18 committee members of the Fed, basically, if as of last meeting, it was 7, now it's 9. So 2 more members basically have changed their stance on raising the Fed funds rate a little bit sooner than where they had initially mentioned 2023, right? It was 2023, and now they're talking about next year. And when you hear next year, you think, well, January is right around the corner. It's, September. That means in January, they're going to start raising rates. No, But that's what the headline is going to read, guys. It's going to say that they changed their stance, that rates are going to go up in 2022. And the reality is they may, but the Fed funds rate likely won't be adjusted until the later part of 2022 if they do decide to do it. So you're looking, I mean, you still got a lot of very similar market activity, in my opinion, as to what you're seeing now outside of maybe the mortgage, bond buying and all that good stuff. Is
Jeb,
that fair to say?
Yeah, and the projections they publish after when they make they have their meeting, then they have the press conference, and then they publish some numbers. And what you're saying here, Fed funds rate projection for 2021 is 0.1, so they're at 0 to 0.25% right now. It's at 0.1. 2022 is 0.3, so 0.25% higher. 23 1%, and they pray and hope 2024 1.8%. So if we were betting over under on that, I'd take the under, but bigger picture, they're saying this time next year, the end of next year, maybe Fed funds is 0.25% higher. And it's always important. What we get is whenever something happens and there's a shock, like last year with COVID, when they cut the Fed funds rate, our phones ring off the hook. Hey, I hear the Fed cut rates to 0. Can I get a 0% rate?
Oh, did you click on that?
Click on what?
Oh, his question was up there. We were kind of talking about it, so I didn't know.
No. I threw it up because I'm like, hey, we're answering that one right now. So, you totally broke my train of thought here. But just a long way of saying, Fed funds does not dictate mortgage rates. What happens and what dictates mortgage rates is the cost of U.S. Treasuries. So the Fed stopping buying $80 billion of Treasuries will have much more of an impact than what they do with Fed funds. And they can't really raise Fed funds because the reason why they were buying bonds is they'd already taken Fed funds to 0. This was another way to go above and beyond that and stimulate or depress rates even more, which they've succeeded in. So when we look going forward, they raise Fed funds. What does that do? It raises credit cards. It's going to raise the prime Fed funds. They'll raise the prime rate. That will lead to higher rates on credit cards, on home equity lines of credit. But we will have to look to treasuries and mortgage bonds to see what that means for mortgage rates. And at the end of the day, for the next year or so, I don't think it means much.
No, agreed. And we've talked about it, right? So over and over and over again, we've talked about it and tried to make sense of it and help you understand it. And what I want you to understand here, again, nobody is tooting their own horn over here, but the stance on this side of it hasn't changed, right? Since go back and watch the videos from April of 2020, saying exactly the same thing we're saying now. And we're in the same, in that position, if not even better economically than what we had forecasted at that point. So, the people that are changing their stance every 3 months, 6 months to get views, that's, I don't know, sad, so to speak. So anyway, let's move on here and get into some questions. That's why people are here. Coinster, he already crashed the like button, so I appreciate that.
I thought he was Coinstar, the guy that you could dump your coins in at the store and get a little voucher out.
Maybe he is, and he takes like 5% of your money for every dollar.
Well, Genius, if you get an Amazon gift certificate, they pay him. Is the better way to do it.
Oh, is that what happens now?
Yeah.
Look at that. But yeah, I think we just addressed that question, right? I don't think anything's coming anytime soon. Al had a question. So when is the last time the Fed wasn't buying mortgage-backed securities, Josh?
So as recently as last year, prior to COVID, okay. They were not buying. They were owned. Out. Yeah, they were 100% out, and they had been for 5-6 years. I have to go back to get you the exact date. So what was it, 13, 14, and 14, they started tapering their buying and then stopped buying sometime around 15. So 5 or 6 years they had been out of the market. What they had never successfully done was sold off all of their holdings of mortgage-backed securities and treasuries. So some people expected that to happen. I would say safely for the rest of all of our lives, the Federal Reserve will own treasuries and mortgage bonds.
There you go. Good stuff. So let's see. Melancore. Yeah, we're just going to go with Melancore. Can you elaborate more on the difference in sales and demand based on price ranges for a first-time buyer like me? I'm looking in the $600,000 range. How does that compare to the higher ranges in the OC? I'm not sure I understand the question exactly.
I think they're just kind of asking about supply and demand at different price ranges. So okay. The first thing this made me think is clients that I have almost in Orange County, the $600,000 price range is almost gone other than condos. So the 650 to 850 range, first time entry level single family buyer, you can vouch for this. Jeb, you just experienced this one firsthand a couple nights ago with a listener to the viewer to the show here. But stuff is hot, like 10, 15, 20 offers. What I can say is I have a client in the Inland Empire that bought at like 1.1 million, which is a much higher price point out there. So on a massive price point, but all of their offers they were making, they were competing with, say, 2, 3, 4 other offers. So the higher you get, there's less competition, at least from my end of what I'm seeing, but there's definitely competition out there. What about what you're seeing, Jeb, with all your clients?
It's stupid. I mean, it really is. It really, I mean, if you're in that price point of, say, 600 to, let's say, 800, 850, super competitive. And there's not a lot out there. I mean, we could run the numbers here in just a minute. I mean, I every week I talk about supply and demand here in Orange County. I meant to do it at the beginning of the show, but I completely forgot. We're under 2,200 active homes on the market here in Orange County. It's the lowest number I can remember seeing in the last 2 months. In a county of 3.3 million people. So less than 2,200 homes. We got as high as 2,600 a couple of weeks ago. We've lost 400 of those. And so what's that? 15%, 17% decline in the number of active listings here in Huntington Beach. We're just under 150 as of today. I think we're at 148 and we got 8 new properties on the market. So prior to today, we were basically even with regards, we were at 140, right? So not moving a lot here, guys. So inventory is coming in markets, right? Every day new properties are coming on the market, but buyers are still out there looking. So if you're in one of these price points that's competitive, it's tough. It really is tough. And I can't stress it enough because, I have buyers right now, a couple of buyers, in fact, 4 or 5 that are in that price point, that probably 7 to 850 price point. And every house I call about has multiple offers. Every one, 14 offers, 9 offers, 7 offers, whatever it is, all of them have that multiple, offer scenario going on. Now, it's different in the fact that, 6 months ago, there were like 20 offers on some of these things, and there still are on some of these properties. And that's what I want to stress is that, while things are slowing down, they haven't slowed down enough to the point where you are the only person out there looking. And people have the whole conception of real estate and the whole idea of real estate has changed over the last 18 months because people have forgotten what real estate was like, right? In a normal market prior to this, you could still have multiple offers on a property, right? You still might have 1 or 2 on a property that's priced right in a market. In fact, you might be the only one. And price reductions are part of a normal market, guys. So when you see a price reduction, that doesn't all of a sudden mean the market, the sky's falling. That is normal activity in a market. In fact, I'm going to talk about it more in a video that I'm going to post tomorrow about what it actually means and how to approach some of this stuff, because people are talking about, well, I'm seeing price reductions in my market, everything must be changing. No, that is normal. People, nobody knows exactly what their house is worth. And in some cases, you got to have to test the waters to see. In some cases, you're wrong, right? In some cases, you do have to adjust a little bit in order to get those properties to sell. And so, I'm going to talk about it again in that video. So if you're interested, check it out. But, people have forgotten what real estate was prior to this and think that any little change means this whole thing is a facade and it's all going to hell, I guess, but it's not reality. Anyway.
No, Jeff, we talked earlier. We talked about that house over in my neighborhood. We talked about it on the show last week. Got another price reduction last week. Came on at $1,550,000, and we both chuckled like that's just not even close to the value of that home. They cut it to $1,450,000. Then earlier this week, $1,350,000. And if you're watching and you don't know anything and you thought it was priced accurately to begin with, you're like, oh my God, the market's dropping. They cut $200,000. And the reality is it's not going to sell at $1,350,000. It'll sell somewhere between $1,200,000 and $1,300,000. And you look at that, you're like, that is a $300,000 price cut. No, it was the wrong price to begin with. And like the property you called on for those folks the other day, they listed at $715,000 and they got 15 offers and they're over $800,000 in 2 days. Well, it wasn't the right price at 715 either. It probably should have been listed at 750 or 775. Yes, it's a desirable property, and that reflects strength in the market, but not, hey, the market didn't go up 10 or 12% this week in that neighborhood. It was underpriced relative to where it should have been. The other home was overpriced. So in looking at it, you have to know your market, and we talk about this all the time. You have to work with experts and professionals in your market that really know it. Your cousin or your sister-in-law may have their real estate license, but if they're not in the market watching things and knowing the neighborhoods you're interested in, super easy to get on the wrong side of it. Now, in the current market, it's almost like an auction. So on eBay, everything kind of goes for the price, other than a buy it now, it's going to go for the price that it should go for. So with that, you're not going to overpay so much in this market just because the market's going to tell you what values are. But if you're selling, you can certainly get on the wrong side of it.
No, absolutely. And then, Ricky mentions a moment ago, overreaction to the speech today, lock my loan 30 years, 2.75 with $4,500 credit. I don't think that's an overreaction. I mean, here's the thing. What's it going to improve, one way or the other, an eighth, and it might get worse. I mean, the idea here behind locking a loan, whether you're refinancing, buying a house, whatever it is, if you're comfortable with the payment and it looks good to you, lock it and move on. And don't watch it every day from now on, right? Be happy that you got a great rate. 2.75 is a solid rate. You're getting a credit. It's a good deal. Like, who cares if rates go down an eighth? You got a solid deal, again. But what happens is people continue to watch it. And then what if it's, the hindsight thing? And so go ahead, Josh.
You guys have heard me say this before a million times. When the day you lock your rate, you know exactly what your rate is. In 3 months, you will not remember what your mortgage rate is. So it is important. It is important to get a good interest rate. Obsessing over getting the absolute lowest interest rate, not as much. So Jeb, I had hinted at this when we were talking about, I just want to share this here real quick. Yep. The only thing you need to know about this chart, this high is good. You want bond prices high. That means that interest rates are low. When they go down, interest rates are low. But this, you look and you're like, oh my God, they're all over the place. Or we were up here and now we're all the way down here and rates are higher. All of this entire range is 0.25% in interest rates. And this is going back to July. So July, August, September, high to low, 0.25% in interest rates. So Ricky, you locked here, which is near the worst levels that we've been in the last 3 months. So someone could go, well, that was dumb. Well, it is, unless this level of support gives way and we go down to a new range. That's a great interest rate. You got a nice lender credit. Move on and be happy. And if we end up, these bond prices run up higher and rates go lower in the future, fantastic. You have the ability to refinance it further on in the future. But like tell people, if you look, we live in a clickbait world. It's not just the crash people all over YouTube and in the headlines, it's interest rates. If you look in your Google feed, your Google News feed, you see, oh, interest rates low, 20-year fixed at all-time low. And you look from our perspective, I watch these every day, and I'm like, well, that's not true. And then you click the headline, and Fox News, half of you think that's fantastic, half of you think it's terrible. But Fox News is an investor in a mortgage company called Credible.com. And if you look, that headline runs in some variation every week, and it's just an advertisement for Credible. And most of those headlines for interest rates are clickbait to scare you that you should lock a rate or tell you that it's a great time to lock a rate and click in. So just don't pay attention to the headlines. Work with an expert and a professional and can advise you and can show you stuff like this. This is all noise, 0.25% from best to worst over the last 3 months. Everyone that locked in the last 3 months with a reputable lender that's not overcharging them got a great rate.
No, so let me ask you a question, Josh. And we don't have to bring up the chart, or well, you can if you want. But when we talked about that rate, he locked it today at 2.75 at the bottom of that trend. And if it were to go back up and bond prices would be higher, interest rates would be lower, what are we talking about in rate on a conventional loan from 2.75 to what?
Two and a half. At 2.5. Okay. At 2.75 with that 4,500 lender credit, I'd be willing to bet this is an FHA loan. So yeah, for the difference between that is 2.75 and 2.5 on your best case scenario.
Right. So I mean, yeah, it's a big. It's a 0.25% difference, but it's not huge. So just had it gone the other way, you would have wished you had locked. So I think you did the right thing. Yeah. But we do have some good questions coming up here, Josh. Let's see. This is one that always stumps people. What's the difference between APR and note rate? or
So
interest rate rather.
the government, in their infinite wisdom, thought they would make it easier for you to compare loans from one lender to the next. So on your loan estimate, some, but not all of the charges are considered prepaid finance charges. So your note rate is the actual rate of interest that you pay on the money that you're borrowing. APR is a synthetic number that accounts for the fact that you're paying closing costs. So they go in there and they add up all the prepaid finance charges. They remove that from your loan amount. So let's say there's $3,000 of prepaid finance charges on a $300,000 loan. They say, well, if I had that $300,000 loan and that payment, but I really only got $297,000, what is the equivalent interest rate? So a $297,000 loan with that payment is going to have a slightly higher interest rate, and that's the APR. The problem is very few people get an accurate APR quote before their loan estimate. There's great intentions behind the loan estimate, but in practical purposes, it's very difficult to get an accurate loan estimate up front. I was going back and forth with a client today, or a viewer of the channel here, in process with another lender, and going through and saying, I don't understand this number, and they're off. Well, they are kind of off, but that's the best that loan officer knows how to do in putting those numbers. And that varies from loan officer to loan officer. So for the most part, don't focus on APR. On a purchase, all of the costs that are outside of box A on your loan estimate are dictated by the transaction. On a refinance, box B and box C are also controlled by the lender, but for the most part, they have an incentive to find escrow and title companies and appraisers that are competitive on their fees. So they should be very similar. There could be a couple $100 difference. The big thing you're looking for is in box A, those are first party charges that you're paying either to the lender or the broker. So points, underwriting fees, doc fees, all that stuff. So if you have two loans, that they're both at 2.75% in Ricky's situation, and one of them has nothing in box A, and one of them has $2,000 in box A or $1,000 in box A, you would be better off at the entry, the 2.75, with no costs there. We can look at the APR and try and compare and calculate, but best case scenario is to get the loan estimate and compare box A to box A. For the client we were looking at today, I told them they're already 2 weeks into the transaction, so you're not going to switch and change to a different lender. But we're looking at it. There was $1,700 in box A, and we're like, well, if you had worked with us, we wouldn't have those box A charges, but the rate was the right rate. So in the grand scheme of things, just like we're saying, you don't stress over 2.5 to 2.75 on a $450,000 loan, and you're 2 weeks into a transaction, you don't switch lenders to save $1,500, $1,700. You're close to the best, and you have competitive terms. Like, one of the things that's funny, I was talking to another regular viewer of the show this week in email, and she said to me, I just want to make sure that I get the absolute lowest rate. And I said, why? What's important about the absolute lowest rate? In that instance, that viewer got good terms. Could I have given them better terms? Yes. Did they get good terms? Yes. So if you're with a professional, an expert that treats you well, answers your questions, and you're close to the best terms, that's more important. If you chase after the absolute lowest rate, you're likely to get someone that's going to lie to you, or someone that doesn't have the same service levels, professionalism, experience. Go with your gut. Talk to multiple people, but do not make your decision off who offers the lowest interest rate.
Yeah, agreed. And it's a complex, like Josh said, in their infinite wisdom, they came up with this strategy to help people compare, or formula to help people compare. And at the end of the day, it's super complex and just throws a whole different, comparison piece into the equation. So at the end of the day, like Josh said, focus on what you're being charged from the lender, especially on a purchase, and what rate you're getting. And then you should be able to, again, Josh says the numbers never lie, put those side by side and determine who is offering the best loan for you. We have another one here for you, Josh. Let's see. I saw it just a moment ago. We had a couple people asking about interest rates. I don't know if you want to jump in that. I mean, you kind of talked about it a moment ago, but we can dive into it in a little bit more detail. let's see here. Here's one for you, Josh. Pretty easy to answer. My fiance and I are looking to buy our first home in Central Valley. Both have over 700 credit scores, make a combined income of 80K. Can we co-sign? So even if you took the income, the credit scores, who cares what the credit scores are? The income, who cares what that is? Can you have a co-signer when getting a loan in order to help you purchase?
Absolutely. And there doesn't need to be a relationship. Jeb and I can go buy a house together. I can buy a house with one of my coworkers. The only issue you come into in terms of co-borrowers, who's an allowable co-borrower, is, are we living in the property, both going to live in the property, or is one of them be a non-occupying co-borrower? You can have a little bit of restrictions with the non-occupying co-borrower, but even in that situation, if someone qualifies for the loan and is willing to sign the loan documents, you don't really have any limitations. You may have heard that in terms of a gift donor, FHA loans have some restrictions on who can be eligible to give you a gift and the type of relationship they have with you. But in terms of co-borrowing, absolutely. If you're both eligible to borrow and willing to sign the loan documents, you can both sign on the loan and qualify together.
And that's regardless of the loan type, or is VA different?
No,
so FHA.
Okay,
well. I'm just asking. Let's just answer the question.
Let's be honest. You're throwing curveballs, Jeb. You're trying to stump the joke man. VA is the only one that's different. The only one that's allowed to co-borrow on a VA loan is a spouse. So you can't have a parent, child, nothing. And that leads us to a common misconception with VA loans. You can have a co-borrower. You can't do zero down. So if Jeb's a veteran and I'm not a veteran, we want to co-borrow together, for Jeb's half of the home, you get zero down. For my half of the home, I have to put 25% down. So it ends up about a 12.5%, 13% down payment. So if you're a veteran and you're thinking about that, it can still be a very good option. VA loan rates are very low. They have no mortgage insurance. So if you have a co-borrower and you have the ability to put the down payment, it can work out really well.
There you go. Good stuff. I just wanted to be clear, because if we didn't do that, somebody was going to come back and say, well, you told me and I'm getting a VA and now it doesn't work. And so we addressed it. So there you have it. Christina gave us a super chat. Thank you, Christina. Christina, awesome YouTube channel out there. I'm sure many of you guys know of her. She's the rock star in the real estate world at the moment. So go check her channel out. In fact, I'm going to be there on Sunday. She does a live every Sunday where she talks about housing and everything. We're going to do something similar to here, but less about the mortgage side of things, I believe. So if you want to check that out, I think it's 1:30 Pacific time, 3:30 Central on Sunday. So come join us. And thanks for being here, Christina, as always. Let's see, Josh,
Jeb,
what do we got?
We actually have a good one here, and it was funny. I thought someone else chimed in and was answering this person's question. They were actually just giving more information and letting us in on the conversation in their head, and this is common. I've had this conversation about 3 times this week, so let's start with it. All right. Ford Focus, so we have a car asking us a question. Marcus from Sacramento. One big concern and fear that I have purchasing a home right now is this. I buy a home for $550 with 20% down. This house was worth $350 3 years ago. So there's more to it, but I actually let's just start with this, Jeb.
Right.
What does the fact that it was $200,000 cheaper 3 years ago have to do with the current market value?
To who? To me or to them? Because to me, it means absolutely nothing. At the end of the day, it's again, we talk about it often. Supply, demand, right? If there were more options out there for you, you might not have to buy that $550,000 home. You might be able to find one for less. But the fact is, you're considering that home because there are no other options out there. But at the same time, money's gotten cheaper, right? Interest rates are significantly less than they were 2 years ago. So I can almost bet you that the payment is probably the same on those 2 homes, or pretty close to it, with regards to the price and the interest rate versus where it was 2 years ago. But Josh, I know you're going to jump in there and talk about wages and a couple other things. So I'll let you do your piece.
Absolutely. My exact thought on this is I don't care what it was worth 3 years ago. It's probably undervalued 3 years ago. 3 years ago, it sounds crazy to say 2018 was 3 years ago. Interest rates were a chunk higher, at least 1%, probably more like 1.5% higher than they are right now. So that's led to some of this. But we also hadn't hit that front end of millennials. Coming into prime buying age. If we go back to 2009, 2010, the big headlines were millennials don't give a shit about houses. They're going to live at home. They're going to rent. They value freedom. They want to hit the road. They want to be able to move from town to town for different jobs. And when millennials were 21, 22, 24 years old, there was probably some truth to that. Now, the biggest group of millennials are hitting that 33 age group, 34, which is prime first-time home buying age. Millennials are the largest cohort of Americans since the baby boomers. We have underbuilt for the last 10 years, at least the last 10 years. We have an undersupply of 4 million homes in the United States, and we have the biggest generation since the baby boomers coming into prime home buying age. So homes were underpriced 3 years ago, and now today, that does not mean that they are overpriced. If
Right.
you look at where we're at, we still next year, the year after that, the year after that are going to be undersupplied for homes. If builders went nuts today, they couldn't fill that 4 million shortfall for 10 years. So when we look at where we're at, we're going to have a shortage of homes and high demand, and we're going to have low interest rates supporting these home values for the foreseeable future. So what was the chart here, Jeb?
No, I want to point this out because this is the chart that I put in the video that I posted. Hell, I don't even know when. It all blends together at this point. But this is from Zillow. This is their national housing inventory. And if you look at this chart right here, 2019 is when their inventory dropped below this 0% threshold, right? 2019. So when you were talking 3 years ago, Josh, inventory was up here, right? Inventory was up here even a year ago, right? This is April of 2020. So you go a year back, inventory was still super, super low. And that's the reason that's driving those home prices up. When you see, back here, you weren't having the issues with homes selling way above the asking price across the board because you had more supply. Once supply went down, demand went up. Demand went up for a number of reasons, not just because of interest rates, but also because people were moving. People were allowed to work from home. People were able to no longer have to commute into the office. They could now work from Arizona if they wanted to. There's a lot of different factors in there playing into that. Plus, Josh mentioned you had first-time home buyers. You got a lot of different factors playing into the demand coming into the market, and that's what is driving that. And now, even though here you're seeing an increase in inventory, you're still well below that threshold that we started at back in 2019 when the decline of supply really started to become a problem. So, just pointing it out, there's, you're paying more for the price of that home. And it would be great if you didn't have to do that. But the reality is, if you want to be a home buyer in this market, you're probably going to have to step up. Otherwise, there's a chance that you're going to be paying more for that home 6 months from now.
So I told you the rest of his question was actually instructive here. So he follows up with 10 years, the home, actually, whose worry is if I buy today and things slow down, I wonder if in 10 years the house will still be 550,000 or less, just not seeing any appreciation for this investment within the next 10 years. And again, you just answered the question. Why would we not have, or how would we not have appreciation when we have a supply-demand imbalance? What happens to prices when you have limited supply and high demand? The demand is not going anywhere, and the supply can't come online. So forward 10 years, maybe that's balanced out. Maybe all of the millennials have been absorbed into the homeowner market. Maybe we have baby boomers starting to die off in higher numbers, and those homes come in and are inventory available. There's nothing in that supply demand balance that's going to change in the near future. So we are going to see, are we going to see 15% growth year over year in the next year? I sure as hell hope not, but 3 to 5%, call it 4% on a $550,000 home, that's $20,000 a year. In 5 years, it's a $650,000 home. And that's a pretty reasonable projection. If you look at, Jeb, that last chart you showed us came from an analysis of some Zillow numbers. Zillow, you can look at their projections over the next 12 months of what home prices are going to do, and they're saying in most markets 8 to 12%. And I sure hope that's not the case. I'm praying, hoping that it's 3, 4, 5%. But what do you got in this one, Jeb?
Well, so this is another chart that I brought up today that I was reading in another article that I think is important to note, right? Is people are worried about foreclosures. People are worried about baby boomers dying off and that becoming the next, inventory to hit the market. This is another piece by Zillow that again, it's asking panelists in this case. So, it's hard to say how accurate it is, but look at where they're saying existing homes. I mean, new inventory is actually going to come from, right? It's 39% of it is coming from existing homeowners selling their homes with the intent to buy a new one. So 40% of the homes that come on the market, those people also need to purchase a home. So there's no new inventory in that 40% that comes to the market, the way I read this. The 22.5% comes from new construction. So we already know new construction is an issue. We know how long it's taken them to build homes. So 22% of that's coming from new construction. And then you've got, okay, landlords. All these landlords are going to sell their property. Okay, 12% of those are going to come from landlords. Existing homeowners with intent to rent, not buy anything. Okay, that's almost 10%. Existing homeowners listing their second homes for sale. Again, 9%. Other 7.2. I don't even know what that is. But older homeowners passing away, 5.5%. And then foreclosures, 5.4%. So the large majority of homes that you're going to see come on the market over the next year are going to be people that need to buy, which means you're going to have that competition in whatever price point they're looking in. So I think it's important to keep this stuff in mind, right? I mean, you're going to see more supply come to the market, but is that supply coming from people that also need to buy a home that are going to take another home from someone else looking? And that's again, we talk about the same stuff over and over again, but you guys always talk about wanting to see data or charts or that sort of thing. So I feel like it's helpful to show it to you that it's not me just making it up, but it is, a lot of it comes with experience and having these conversations with people that are smarter, brighter than me, reading, these articles and that sort of thing. And so while I don't always show you the charts and the data, it's actually coming from places of good information, good quality information in most cases, if you consider Zillow quality. But
Jeb, I told you, I like Marcus's questions that he's asking here. We're not even done with him. He says,
all right, let's go.
Says, I don't see any appreciation in this investment for the next 10 years. We need to go through a recession too at some point. It's just unsustainable.
Didn't we just do that?
It's just, so hold on, brother. We got charts. Remember, this is what we do around here. I just got.
We're chart people now.
We are a new chart show. We chart heavily around here. So I've got another chart here. So let's.
And if you work for Bang, I'd like a sponsorship. Thank you.
Don't beg for sponsorships. So you are correct. This little gray bar is our most recent recession. Doesn't count. It was COVID-led. It was over before it started, and it also led to this giant hockey stick over here. So let's go back. 1990 recession. We had a recession that lasted a year, better part of a year, did almost nothing to home prices. Now home prices were flat and level, didn't decrease home prices. We had one in 2000. Home prices going up steadily through that time. This does not count. And I'm not saying it doesn't count because it supports that home values come down in a recession. This recession was caused by housing. So that's not, they call it the Great Recession. It's the biggest recession we've ever had, biggest financial downturn other than the Depression, and it was 100% led by housing. And these prices, basically all gains after about 2004 were all phantom gains where people did not have purchasing power. A thing that I've talked to multiple people about this week is we talk here on the show about supply and demand. Supply and demand are really important. Demand when it comes to houses is a little bit interesting in that both Jeb and I would love to go to Malibu and buy a house on the beach. They're about $20 million. So we are willing demand. We're willing to buy a house on the beach in Malibu. We are not able to demand because we don't have $20 million in the bank to pay for it or anyone willing to loan us the money to do it. So what happened here is where the housing market would normally have stopped somewhere around here in 2004, between those two gray bars, what happened is lenders said, Oh, we don't care. We'll loan you the money. You don't have a good credit score? No problem. You don't have a down payment? No problem. You can't show us that you have a job? No problem. So we had a massive run up in prices, and this correction in this recession coincided. That correction in home prices, monstrous correction in home prices, led to this recession. So it wasn't the other way around. This recession didn't cause home prices to drop. These home prices dropping caused this recession. So long way of saying, recession has almost nothing to do with home values, very little correlation over the long haul. We likely will get a recession at some point, but you just saw we went, 13 years of expansion. What was it, from late 2009 all the way into early 2020? 11 years of expansion, but it was also the slowest recovery. We had about 2% growth, a little two and change over that timeline. Very likely that we could have another 5-7 years of slow growth. There could be a correction and a recession in there. I certainly wouldn't debate against it or argue against it. It's just not going to have much to do with home values. So you have a supply and demand imbalance, not likely to change anytime soon. Any recession is not likely to be much different than the COVID recession here, in that recession impacted some people extremely hard. But most people, the cohort that's buying homes, it impacted them almost none. You've looked at the numbers. People at the top end of the income distribution did very well during COVID. People at the bottom end of the income distribution, who are far more likely to be renters, did quite poorly. So, hearing things like it's unsustainable, it's unsustainable because it looks that way from a distance, and from a wishful perspective, that Marcus would much rather buy the homes that he could buy now for $550 at $350. Doesn't mean we're going to get a correction to that level, or it's going to happen. And for the next 2, 3, 4 years, it's not going to happen at all. This isn't, I'm not cheerleading for higher home prices. We're reading the numbers and saying there's really no other direction for them to go for the next 2, 3, 4 years.
No, agreed. And I'm reading some of the comments here. It's a lot. There's a lot of comments and not a lot of questions. So I'm trying to find the questions. That's why I'm looking up here to the side. But Brian has a comment that I think goes with what I was talking about a moment ago. So he's talking about how bad is new construction? Signed a contract in March for a December 30th close. They haven't broke ground yet. And he goes on to say that the builder's terrible at communicating. So 22% of the homes coming to the market over the next year are supposed to come from new construction. So imagine if the builders can't meet up with that demand. So that's less demand. And I actually have a friend that just moved from Southern California to North Florida market, not North Florida, Orlando market, he works for a home builder. They're going to be building a lot of homes out there. Basically, he's saying that they can't keep up with demand. They're not even in a position to put these homes on the market, because if they did, they would sell them immediately. So they're trying to work it out where the homes come on the market a little bit slower, and they can work through the demand issues versus trying to sell all of these at one time, which is maybe what the builder did here with Brian, and not in a position to get to it just because they're so backed up. Instead, they're going to release them on a little bit smaller scale. So that's the Florida market, guys. It's happening, and not just in Florida, it's happening everywhere. It is a problem, and it's not just a problem because of lumber costs, right? That's gone down. It's a problem with finding good workers, with finding, there's so many factors that play into it. If you drove down the coast of Huntington Beach, down the Pacific Coast Highway here in Huntington, I read an article just a couple of days ago. There are more container ships out there now than there have ever been in history, with regards that are parked right off the coast. And we have a chart of that, Josh, that if you pull it up from Malden.
That was my favorite one. Let me see if I can find it. That was my favorite.
This is incredible, guys, because this just shows you how backed up things are, and how, again, supply and demand. And I'm just take housing, pretend like we're not even talking about housing. Let's just talk about something else: furniture, anything else that you want to buy, a car. I'm going to be in the market for a car here soon, because my wife's car blew up again. So for those of you asked last week how it was going, as of Wednesday, it was going really good, because I had just gotten it back, I think, earlier that day. Well, on Friday, it blew up again. So it's not doing so well. So I'm in the market for a car. I'm looking at cars out there. It is absolutely stupid what some of these things are selling for with regards to home prices. Now, take into account furniture and all of these other things. They're parked in these container ships off the coast, and they can't even dock them. They can't dock them because, for one, there's so many ships in front of them that need to dock first, but then you have no workers at the dock to unload it. And then you don't have the drivers once they unload it to actually deliver it. And then you don't have the trucks that the drivers can drive to deliver it because they're behind on inventory. It's a problem, guys, and it's going to be for quite some time. Look at that chart. That's the number of ships sitting off the coast right now of basically where we are in Huntington. Ooh. You went to Gavin Newsom, bro. What happened?
I went to Gavin Newsom. That was
bad. We don't mention his name here.
No, what I was looking for is the green dots are interesting. The actual photos of it are nuts. We have this. The union for the longshoremen strike about every 6 or 7 years, and then we can tell because we look out on the coast here in Huntington, and there's ships stacked up forever. So I've seen that my entire life, every 6, 7 years. This is nuts. I've never seen anything close to like this. Those ships go on forever. We were in Newport yesterday, and there's a couple ships almost out in Newport. For those of you that aren't here and don't look at the chart, that's a long ass ways for giant ships to be stacked up waiting to get unloaded.
Right. So it just goes, I mean, a lot of what's happening in the US in different industries all ties back to supply and demand. And it's not that, it's there. It's just, people, in this case, they can't deliver it for all the reasons that I mentioned earlier. And in some ways that ties into to housing just because of everything else going on. So anyway, let's move on. Let's try to find some questions here. We've gone down a rabbit hole, so to speak.
So we actually here, I'm going to throw this one up. Read this while I'm trying to find a piece of information.
All right. Ali says, hi, filed bankruptcy chapter 7 2 years ago. I'm making $100,000 with credit score 700. Oh, with credit score 700. What is the limit of FHA I can get in Dallas? And can I get a conventional loan? So, Josh, you already have your answer. I know conventional is going to be 4 years.
Conventional is going to be 4. FHA is 2, so he's on the right track. 2 years from discharge. 411,700 in Dallas. We talked about this, hinted at it a little bit last week or maybe the week before. We're getting towards the end of the year and really close to getting new loan limits for next year. I need to check and see how FHA sets their loan limits. The conventional loan limits, they base the increases annually off the FHFA home price index, which we'll see where it levels out, but it's looking like it's going to be somewhere in the 15% range. So that 548 to 250 is going to jump up, what, another $75,000. So we'll be in the 625 range for a standard balance, and another 120,000 on that 822 375. That's going to put you into the low nines, low to mid nines. So FHA will increase. Also, I would expect at least a 10% increase. So if you're needing to get to the 450 range for a loan amount, give it till the first of the year, and we'll get the announcement late in the year. Conventional loans announce like right before Thanksgiving, and we can start closing those loans in December. FHA is for case numbers effective next year, so it just takes a little longer for those to kick in. But we'll know by the end of the year what the loan limits will be for 2022, if that helps.
No. All right. I think that's good to note too. If you're on the threshold of using FHA or conventional, it may be worth waiting just a little bit so if you can get that conventional loan, because get that FHA loan when the loan limits change. Yeah, just a taste. If you're on that border of 3.5% or 5% down.
Well, Jeb, for us here locally, the big thing is we have a lot of clients that get forced out of Orange and LA County. They go to Riverside, San Bernardino counties that have much lower FHA loan limits. It'll be interesting to see when those jump at the first of the year, if we see home prices also take a big jump. So we talk about willing and able demand. There's plenty of willing and able to qualify demand for Riverside, San Bernardino County, and I would assume similar counties around the country, but they can't qualify conventionally. Like Ali can't qualify because of the BK conventionally, but he makes plenty enough money. There's a lot of those people. I don't know there's going to be a huge impact, but I would bet in those heavily FHA areas, when we get a nice increase to the values, you'll see a little bit of a pop to home prices in those areas because of it.
Well, it's going to be interesting. Here you go. So Steven asked a question. What are your thoughts on all the homeowners that got FHA loans, 3.5% down? Well, if they got them a year ago, they look like geniuses, because now a lot of them have the equity to be able to remove it and get into a conventional loan. But we talk about this all the time, Josh. Thoughts on FHA?
So FHA is a lower credit quality. If you look at lower credit scores, lower down payment, higher debt to income ratios than other loans. So they're all definitely a riskier loan. Over the long haul, they've performed pretty well for the credit standards and the down payment that we have. Down payment is probably the least predictive of loss going forward. Debt to income is better, credit score is better. What low down payment tells you is loss severity during a loss. So if we're saying that anyone that bought in the last 12 months, so if you bought 12 months ago, you put 3.5% down, you've built up 12 to 20% additional equity on top of that. You have no concerns. If you bought 6 months ago, you have 7, 8, 10% on top of your 3.5% down. I don't see an issue where these people, I don't see it stopping right here. I don't see it decreasing, don't see it stopping. So I really have no concerns over that. FHA loans are riskier loans. The HUD and the government run that program for a purpose. So people at the lower ends of the financial spectrum get to participate in homeownership, which is one of the greatest predictors of wealth and builders of long-term wealth. So it's not going to go away. We're not going to change it. We're not going to take it away. It didn't really significantly change after the Great Recession, so it won't change during this any future downturn or any future change, which we don't see coming. So I literally have no risk or no concern about this. And the best example, Jeb, 2 months ago, Freddie popped up on the show and said, "Hey, bought in San Diego last November. I think my home's gone up enough that I can get out of my FHA into a conventional and get rid of mortgage insurance." And we said, probably not. But you look at the numbers, maybe you're up to 15% equity, and we could go to conventional with much lower mortgage insurance. It wasn't even close. The thing came out at like 75% loan to value, not at 80%. So San Diego's an outlier. It's one of the hottest markets in the country, but even the coolest markets are up 8 to 10%. So those people are sitting on double-digit equity. Got zero concern about it.
Yeah, and another thing to keep in mind too is, like, people, when they buy a house, it's, they're more likely to pay their house payment before they pay their credit card or their other payments, right? Because it's security of staying in a house, having their family there, right? Not having to uproot kids, I wouldn't even say build wealth in a lot of these cases, because that's not really what's in consideration. It's actually being able to make the payment. So if people get in a financial strain and they've only put 3.5% down, chances are that, the market has appreciated since they purchased, but you still have people using them. But at the rates of where it costs to rent at the moment versus where mortgage payments are, it's a trade-off in some of these areas. And in fact, it might be cheaper to own in some of these markets than it is to rent, just because of where prices have gone. But people typically, tend to pay their housing expenses prior to paying some of the other stuff, because they need a roof over their head and what have you. Now, it's going to be hard to say how that really plays out, over the next couple of months, because people have gotten the idea that the government's going to take care of them in some of these cases, and that you don't have to do, make payments and all of that. And that's a whole different rabbit hole that we can talk about, because we're guessing, right? We have no idea if people are really going to go that direction. But at the end of the day, like Josh said, these loans tend to perform pretty well in the big picture. So it'll be interesting to see how it plays out, but I don't think it's going to happen anytime soon.
Hey, Jeb, we got a good one here.
Yep.
Johnny Stash put his house back on the market, got offered $25,000 over asking, but he doesn't think it'll appraise. Should he accept the offer or counter and ask for the appraisal difference? What would you advise a seller in this situation?
That's tough to say. If you think the buyer might be willing to negotiate with you, if the appraisal came in short. I mean, here's the thing: is you throw the appraisal difference out there, you could scare them away to the point where they don't want to move forward with an offer, right? And so they just go bye. Or unless it's a reasonable appraisal difference in that case, right? Maybe $5,000 or something. And even then you could scare them. Or ask your agent, "Hey, agent, what do we think this can reasonably appraise for? Okay, it's this. And if it's somewhere close to what they're asking, then, I mean, obviously your appraiser needs to show up when the appraiser, your agent needs to show up when the appraiser is there anyway to show them how you got to that value and help justify it in any way they can if they ask the right questions and that sort of thing. So, it's a tough question. Each scenario is going to be a little bit different. I think if you were in a multiple offer situation, it would be a little bit easier to ask for the appraisal difference. If that's the only offer that you have, I would probably push you more to accept the offer as it is and then negotiate after the fact, right? After the fact, they've spent a little bit of money. They paid for an appraisal. Chances are they probably had a home inspection. They might not be willing to pay the full difference if it's $25,000, but they might be willing to pay 5 or 7 or split something with you in order to make it work. And so that could be the better approach, but it's hard to say. I can't give you an exact answer because it's, each scenario is going to be a little bit different, but hopefully that guides you in the right direction.
Our friend Marcus is back with a follow-up question.
All right.
Jeb. And honestly, I love the thinking here. Like what pains me more than anything is people that jump into buying a house without thinking it all the way through. So at the end of the day, when we get through this, I truly hope Marcus makes the decision to buy a home. But if he doesn't, he's asking the right questions and his answers are more important to him and his family than what I think. He's educating himself. He's going to get other people's opinions. Hopefully data validated opinions, but he's going to make a decision with that. So here, what about Fed projections to raise rates and inflation worries? If interest rates by 2023 go to 4%, wouldn't that drive home prices down? So I want to start at the end. If if interest rates went to 4%, I don't think it would drive home prices down. It would absolutely put the brakes on the appreciation that we're seeing. It goes back to that question of willing and able demand. At a 1% higher interest rate, payments are higher. People are getting pushed down in terms of what their maximum debt to income ratio, their maximum comfort level with a payment would allow. So we're taking away able demand. It would slow the market. I don't think it would cause it to go down. If we get to 4.5%, 5%, you're starting to strain credibility there for what's going to happen. And the reason for that, the reason why I say it won't cause the market to go down, the market only drops when people are willing to sell their home at a loss. So they could be unwilling and have to sell their home at a loss under financial stress. But other than that, home prices, prior to the Great Recession and the big downturn in home prices, people like to say home prices are sticky to the upside. And the reason being is when home prices go up, people will sell as home prices are going up. People don't want to sell at a lower price than the last sale in their neighborhood. So only people that are forced to sell, that are under financial stress, get moved for a job, will sell. So it would lead more to stagnation than a decrease in home prices. People just will decide to stay put longer, which, one of the charts, Jeb, in the report that you put up earlier, was showing duration in home. We're now up to like 11 years is the average duration for an owner in a home. That would just drag that out even longer and limit supply more. So Fed projections to raise rates, the Fed is going to raise the rates that they control. Fed funds rate, prime rate. They do not dictate interest rates. If you look going back to 1982, we're in a 40-year bull market in bonds, causing interest rates to go down. The prime reason for that is excess government borrowing and government debt through that time frame. If you look at GDP, GDP has decreased through that time, and interest rates in the long haul are largely a reflection of a yield on top of GDP. When we have low growth, we're going to have low inflation and we're going to have low interest rates. There's some really smart people making a case for why we're going to have inflation. I don't necessarily disagree with the things that they're saying. I disagree with their conclusions. And I don't think we're going to have interest rates go very high. The last piece I would say is, if something can't be true, it won't be true. The government has borrowed in the last 13 years 4 times more than they'd ever borrowed. So we went from like $7 trillion to closing in on $30 trillion of federal debt. If they allow interest rates to go up 1% from here, they don't have the money to pay it. So the government has a massive incentive to manipulate the markets to keep interest rates low as long as they can. And side effects of really high and inflated home prices, they don't really concern themselves with it.
There you go. Well said. And we've talked about that many, many times before as well. If you guys are watching, we're here just over an hour. 267 of you on, 58 likes. Can you guys like it, share it, help us get the word out there? We appreciate you guys being here, and yeah, we're doing it to help you guys become better buyers, better sellers out there in the housing market. So thank you. Let's we can put that one on there. I don't know where it is. Gosh.
Where you went and got the thumb on.
I got a thumb, bro, but I don't know where the question is. There we go. We'll remove it. There you go. So like and subscribe, people, please. I hate begging for this crap. Begging, bro, begging. Let's see here. We got a good question a moment ago from Michael DeRee. So Michael is asking the question, Josh, what is the upside to building equity in a home if you don't ever have any plans of moving and or taking that cash out?
You end up with a home that you own free and clear, and you don't have a monthly payment for shelter over your head would be the primary one to me.
Or you could pass it on to, right? If you have kids, you have family, it becomes an asset again, essentially at some point where it's paid free and clear, and it's wealth, right? You could use that money at some point in the future if you needed to. You could use it for retirement. There's ways to have that house pay you every month. It's a nest egg to pass along to family at the end of the day. There's tax deductions that go along with it. There's multiple reasons to own a home, but at the end of the day, security and the long-term benefits are probably the biggest factors in owning a property. For sure.
Everyone's going to view it differently, whether you have kids or don't have kids. My dad was a school teacher. He wasn't a wealthy man, but he paid his house off during his lifetime, and he was so proud that he was able to leave a free and clear home to my sister and I. Now, my sister and I own our own homes. We would have been fine without it, but it made him proud, and it's a nice tailwind for us to make things better financially. So, it was funny that you went that direction. I hadn't even thought of it, Jeb, but it made me think exactly of how happy and proud my dad was to leave that to us. And for the last 10 years of his life, he didn't have to pay to put a roof over his head other than his property taxes.
No, exactly. Which, fortunately, being in California, stayed pretty low. Here you go. So Michelle has a question. Can you sell your home a year after buying if you have $400,000 in equity? And the answer is yeah. You could sell it a day after you buy it if you want to, but understand if you've gained the equity from owning that property, if you sell it within that 2-year period of owning it as your primary home, and you've lived in it 2 of the last 5 years, you'd be able to take that capital gains exemption. But selling it in a year, you're going to have capital gains on it, right? So you're going to have to pay some taxes on those gains if that equity came from appreciation in that home. So yeah, the answer is yes, but just understand there might be some tax consequences. So make sure you're talking to a tax professional that can guide you through that if that's something you're considering.
A couple things in that, Jeb. One of the biggest misconceptions that I get a couple times a year, someone will ask, hey, so we have $400,000 equity in our home, so do I have to pay taxes on that? So not talking about the 2 and 5, you don't pay taxes on the equity that you sell when you sell the home. You pay taxes on the gains. So in this instance, if they put $200,000 down and it went up $200,000, they could sell and they would be taxed on the $200,000 in gains. So it's important. Some people just get that confused and think that, hey, everything I walk away from, you're only going to get taxed on the gains. If they had put in $50,000 of capital improvements in addition to their $200,000, the gain is only $150,000. So it's important to talk to a good tax advisor when you're thinking through these things. And it made me come back to a question, and I promise, Jeb, I'm not trying to stump you with this. I'm just not remembering exactly what they are. There are some exemptions where you can get a partial deduction. So what are those? Like if you can prove you get moved for a job 12 months in, I believe.
Yeah, I think it has to be at least a year that you've lived in the property, if I remember correctly. And from that point forward, you can get a partial. But I honestly don't remember all of them.
Every time it comes up, I refer it to Kevin just because it is specific. You have to meet several criteria, and you need to be able to document it because the IRS is going to come sniffing around if you take the exemption in less than 2 years, the deduction.
Yeah, I honestly don't know the answer to it, but you know what? We'll look it up and have it next week. And because I've actually done a video on 1031s or not 1031s. Wow, on capital gains, and never mentioned the partial exemption on that. So that's something that I need to look into. All
So,
right. Go
Jeb,
ahead.
I've been looking at a couple of these questions,
All
and
right.
I don't know that we go super deep on this, but I don't know if it's the same person asking or two different people. I literally think it's two different people asking. Please cover SB 9 and 10 and what this means for the future of California. So that was why our idiot Governor Newsom was up on the page. He's very proud of this, that urban planning for time immemorial has been built around the fact that any given area can only sustain a certain level of density unless you want to be Manhattan. So where we live here in Huntington Beach, California, it's a suburban community. It was never designed to be ultra dense. Our overlords here in Sacramento think that rather than all of the open spaces that we have in California that could be developed to provide homes for people who don't own homes or to lower home prices, that we should increase density in communities that were not designed for it. Some of the guidelines we have in terms of ADUs, you can build an ADU in your backyard in California and you don't have to have parking for it. So if everyone on your street builds an ADU, rents it out to a family that has 2 automobiles, you now have 40, 50, 60, 100 more cars in your neighborhood that never were intended for it. So these ideas sound really good on paper, but in reality, they're not likely to play out well. So
let's just talk about what it is, because there's a lot of people out there right now that have no idea what the hell you're talking about, Josh. But before we do that, Michelle, you gave us $5. I didn't realize that until just now. So thank you for the super chat. I appreciate it. We appreciate it. Josh gets nothing. I make him sit there and he just answers
me.
questions.
He's got the little string with the 805 on there, and he just holds it out in front of me.
It's a sweatshop in here. I say, Josh, you answer questions, and I will see you tomorrow. I'll see you next Wednesday. Anyway, SB 9. So SB 9, in layman terms, allows what, Josh? So most communities have single-family homes. They have one home on a lot. SB 9 does what?
I don't know the exact details on it. It allows increased density. A city can't say you can't build an ADU. They can't have parking requirements to say, hey, if you're going to build this. So it allows, in communities where we always said you had to have a garage with that property, now you convert the garage to a living area without replacing that parking space. So somehow in California, we've decided that those crazy people for the last 80 years that were actually planning their communities and had zoning laws for what you could build in certain areas, that they were dumb. They were dumb, and you should be able to do whatever the hell you want.
But this is going to solve the housing crisis. Building an ADU in the backyard is going to solve the housing crisis. Now, what's the one that just came out? Is it it's not SB 9, but it's the other one that came out where now you can add, basically you can divide your home and convert it into a duplex and or multiple units. And that's not the SB 9, is it? Is that the SB 10?
For those of you in the other 49 states, the look on my face tells you that I try to not pay attention to what our idiots in Sacramento do.
Anyway, we're losing people here the more we talk about this. I actually plan on doing a video about it. I have it written down. I have some notes on it. I'm going to talk about it in more detail. But at the end of the day, what all of this stuff does is allow you to take a lot that was intended for one home now could have multiple properties on it. So the ADUs is one deal, but being able to divide a lot and make it a duplex now is a whole different animal. But my understanding with that one is that the city that you live in, the county that you live in, has to allow that, right? So their laws actually supersede the laws of that one versus the ADU. In those cases, you can do those without actually having to have some of the approvals there. But again, don't take my words 100% because I haven't done all the due diligence on it, but I will post a video. It'll probably get posted next week. So hang tight on that, guys. Anyway,
Jeb, we want Jeb Stradamus to weigh in on this one. YouTube Car Spotters Guide, probably a nice YouTube channel about fancy cars like that Ford GT there. Will homes double in value in the next 10 years?
I can't see that happening. My mind would be blown. I bought my house in the property I live in now at 2012. Just by chance, got lucky, and the market went crazy at the end, beginning of 2013, and has gone up ever since. I remember telling my wife at that time, this house, is going to double in value. She thought I was crazy. Now, I didn't expect that to happen in,
in 8
the
years
time frame in which it happened, but it did. And so if you told me now that it was going to double in value again, I would at this point, I would have my wife's stance and say, you're crazy. I don't think that's going to happen. But I do think appreciation is something that is going to continue for the foreseeable future. And when I say that, you've got a couple of different platforms, and I say platforms at the moment. You got CoreLogic, out there saying that, what their appreciation is. You've got, the National Association of Realtors posting theirs. You've got the different media outlets, if you will, all posting their forecast for basically 2022. And I think the least appreciation of any of them is CoreLogic at 2.7%. And if you guys, we talked about them, they were also, at the beginning of the pandemic, Josh, they were reporting what?
Minus 6.6 last year was what
they were a 6.6 decline when we appreciated 18%. So they were only off by 25% at that time. And so now they're predicting a 2.7, I think, percent appreciation next year. So, if that's any indication, you're going to be up 30%. But no, really, I think you're going to see what's more normal, right? Probably 4 to 5%, I think is normal. And nobody predicted what we saw last year, percentage wise. People thought prices were going to increase, but nobody predicted 20% or 30% in some of these markets out there. And so to throw those numbers out there, I think are crazy. But, again, your guess is probably as good as mine, because I think it's hard to tell, what people are going to do, because I think the more people feel like FOMO is happening, the more people jump in, and you get the craziness that we've seen.
Let me throw some really rough numbers. We could get you a pretty good answer to this with a couple hours and a spreadsheet. But if you look right now, people are saying, oh my God, the home prices are higher than they were at the peak. But we've talked on the show here that doesn't matter. What matters is what the percentage of household incomes go to support the mortgage payment. So what goes into that? Household incomes have gone up since that time. Interest rates have gone down. So we have more income to pay a smaller payment. So when you look at those numbers, homes are 40% more affordable than they were at the last peak. If you remember back when we pulled up the chart and showed that last peak just before the recession, we said that peak was bullshit because those people didn't have to qualify. So if we say we're 40% more affordable, that doesn't mean we have 40% more room to go up in prices, because we can't hit that last peak, because now people have to put a down payment, have to have decent credit scores, have to have income. So does that mean that we've got 20%, 25% headroom above us? That sounds about right. So does that mean we're saying, okay, homes can only go up 20% more? No, because incomes are likely to continue increasing. And if you followed us for any period of time, I think interest rates are going to continue to go lower. So that's a moving target as we move forward and see what's happening with median incomes and what's happening with interest rates. That can and will go higher. But right now, my guess would be there's probably only about another 20%. So Jeb's saying, people projecting 8, 10, 11% in the next year. If that happens, we're getting within 8 or 10% of the ceiling. There's a bunch of comments over here of people saying it has to come down. It's going to come down. I can't wait. I'm rooting for it to come down. I don't mean to destroy your dreams, but the actual numbers
but
tell
that's
you
why I'm here. That's why I invited Josh. So I didn't want to do it, so I let Josh do it.
Numbers never lie. So the numbers are destroying your dreams. We have more room to go, and that will happen. My hope is that we moderate and we get 3 to 5% growth for the next 10 years. History shows that's not what happens. We overshoot. So we probably will get 7 or 8% in the next year, and another 4 or 5%, and another 2 or 3%. And we really do hit a true peak where we just have a limited supply of people who can afford and are that willing and able demand. So 10% or doubling in 10 years at 7% a year for the next 10 years. There's no way to support it. Incomes aren't going to go up that much. Interest rates don't have that much more room to come down. So I would bet you everything I own, they do not double in the next 10 years, not because that's my opinion, because the numbers just say that we don't have enough people making enough money to push them to that level.
Got it. So we're going to get off the housing bubble talk, crash, appreciation talk. We're actually going to get some real numbers here and some stuff that we can use to help people. Edgar Yamas is asking a question. How do we add income from a side gig that we've been doing for 1 year, Josh? If I'm a YouTuber and I make some money, can I use that income as my income in order to help me qualify?
Very, very hard to do it. Bank statement loans will allow you to do it with 12 months, and some of them will allow you to use your W-2 income from your primary job and your side job, but they're going to have worse rates and bigger down payment requirements. Somewhere around 18 months, you can start, maybe talking to a lender about using it. 2 years is where you absolutely can. 2 years on the tax return. So we have a lot of people that unfortunately start their business, at the end of the year. So there's this tiny little bit and most likely a loss on the tax return. Then we get 1 full year and we almost need another full year before we can use those numbers. That's another thing to remember. These side gigs, most people that I see, they'll tell me they make, hey, I've got $20,000 in my side gig, and I see the Schedule C, and it was a $2,400 loss. So remember, you're never going to be able to use it to qualify if you use it to offset your car payment, your cell phone, all those things. So it's not to say that's not a bad thing to do. It's not to say that it's not right under the tax law. Just remember, the dollars you bring in only count to the extent that they exceed the expenses that you claim on your gig job.
Got it. Yep. No, absolutely. And now here's the difference. If you're a corporation or if you're incorporated, self-employed, if you can get the side gig to pay your company, all that money gets funneled into the same spot. So it can be added as your income, right, Josh?
If you already have a business and you just declared it as additional income, you could game the system a little bit that way. At the end of the day, lenders are not the IRS. They're not the IRS police. Even if you complete your tax return horrifically wrong, as long as we can document that is what was filed with the IRS, we're going to analyze that tax return according to accepted underwriting principles, and we're going to arrive at that income. So lots of things that you can do.
Yeah, and I know we talked about SB 9 a moment ago, so I'm going to answer this question real quick. I do believe it can increase the value of a single family home. Absolutely, especially if it has the lot size to build an additional unit. I've seen it personally. In fact, in North Long Beach, I saw a property that was priced considerably above the other homes in the neighborhood. I noticed it had a bigger lot, and it ended up selling for quite a bit more than the other homes in that neighborhood. And I can almost assure you that they were going to build an ADU on that property, which is going to bring in more income than what they're paying on that mortgage. So yes, in many cases that could happen, especially in markets that are a little more of the density. You have the generational type living, that sort of thing. I could see it happening. Absolutely. But it's not going to happen all over the place because some neighborhoods just aren't going to allow it because of street parking and other things that are affected by it. Here's one, Josh. I saw it a moment ago. Let me see here. They were asking about Social Security and their kid. Let's see. Josh, where was it, buddy? Do you see it? They were asking about buying a home and having to provide Social Security for their child in order to qualify for the loan. It was Zachary. I know where it was. Zach, if you see it, post it.
You find it. I've got a good one here I'm going to answer while you're digging around. Two-row man 616 says, "Hi guys, just bought my home in January, FHA with mine and parents' credit. Maybe a job opportunity for me in Oregon. My credit is low, 630. How hard would it be to buy in Oregon on a conventional loan?" Good news is you don't have to buy on a conventional loan. You can have 2 FHA loans. There's a 100-mile rule. You have to be more than 100 miles away. If we can show you have a job move that led you to another area, that's a valid reason to move, and you can use the FHA financing in that instance. So there's some additional documentation, but with a 630, you can get a conventional loan. The problem is on the lower FICO scores, conventional loans are almost always going to require an automated underwrite. Fannie and Freddie allow manual underwrites. Just very, very, very few lenders do them. At 630, you will probably get an automated approval, but it's going to be lower DTI. You may need to have some reserves. So it just gets tougher from that perspective.
No, that's good stuff to note. I wasn't 100% clear on being able to have 2 FHA loans. So I'm learning as well, guys. That's what it's about, right? So here's the question from Zachary. So Zachary says, why do I need to provide my son's Social Security survival benefits from his mom's passing when that income won't last the life of the loan?
Simple one. Underwriting guidelines don't require income to last the life of the loan. It has to have a continuance of at least 3 years. So if your son's 16, we can't use it. If your son's 12, we can use it. If your son's 14 and a half, we can use it. So that's why they're wanting to document your child's age and the proof of that income. And it's to get you qualified. So if you don't qualify without that income, you don't have to provide it. There's nothing that you have to provide. The loan officer is just telling you what is usable income. So anything that continues for 3.5 or 3 years or more. Best example I can give you, we did a refinance for a lady that she has it's an IRA and it's an annuity. That annuity runs out in 39 months. Not a problem. We use that income to qualify her for the loan because that's what the underwriting guidelines state.
All right, good stuff. Good stuff. Somebody just said give Josh the money to get a haircut. So Ray wants me to hand the money to you for a haircut, Josh.
Bro, other than
Bro,
Ray's,
by the time
other
the
than
viewers
Ray's
get done
bulldog,
with you,
other
by the
than
time
Ray,
the
yeah,
viewers get done with you, you're gonna have a new haircut, a new shirt.
By the
It's gonna
time
be,
they get
bro,
done
you're gonna
with
be
me,
awesome.
I'll be basic and common like people living out in Texas and other hinterlands of California.
There we go. That's the Josh I know. Jennifer accidentally removed Armand's question, but the question was, is it good or bad to lease to own? So if you can find a lease to own property, so how these work is typically you're leasing a property and there's a contract involved, and every single month when you make that lease payment, typically these are how these are structured. Not all of them are the same, but a portion of that lease payment, you're usually paying more for that lease than you would just to lease it, right? A little bit more for that property. A portion of that lease is essentially going into an escrow account, if you will, and that's going to go towards the purchase of that home in set time, whatever your time was. Now, if you can find a lease option in this market at a reasonable price, it may be worth considering, especially if you're, we think appreciation is going to happen over the next couple of years. These are really good for people that are in a position that want to purchase something, maybe aren't financially able to because of one reason or another, but are going to be able to in a couple of years. They're great. Now, traditionally what happens with these is they usually require some sort of down payment up front to the person that you're going to lease to own from in order for them to do this agreement with you, at which point you don't convert that lease to an own. They get to keep that money. So it's not as simple as, hey, I just go into a contract and I agree to purchase Josh's home for $300,000 in 5 years, and I just pay him the lease, and in 5 years I get to buy the house. There's usually some sort of downside to that agreement that if you don't move forward with it for whatever reason, say the market does decline or doesn't appreciate or whatever, there's got to be, some sort of consequence for you not moving forward on that, and that owner potentially tying up their property for that period of time. So, to get back to the original question, is it a good idea? It can be, absolutely, but just make sure you're getting in at the right terms, right? Make sure they're not trying to oversell you on the price of a property based on where the market is right now, right? If they're trying to sell it significantly higher than what it's actually valued at, then it's probably not a good idea because, you're only going to be able to reach that price, after a couple of years of appreciation. So anything you want to add on that, Josh?
Yeah, in real terms, just know that lease options are 253% bullshit, and they're there for the seller of the property. Jeb gave the nice realtor answer. I was on a call last week with a housing advocate, and the topic came up, and he actually had the statistic less than 10% of them actually ever close. As Jeb said, you pay upfront option money, and you pay an above market rent. So the above market rent should be applied to your down payment and closing costs when the time comes to convert. These are generally done to get the above market rent and to maximize the landlord's money out of the property. Because think about it, we're sitting here talking about home prices going away at super high values. Why would I sell to you at today's price when the sale isn't going to close for 1 or 2 years? What the theory behind it is hey, someone that's got banged up credit, or Ali in Texas, he just hit 2 years on his bankruptcy. What about 1 year ago? And he has a landlord that says, I like Ali, I'd like to sell him the house. And in 1 year, he'll be able to qualify for FHA financing. Let's do this. He gives him time to clear his credit, maximize his credit scores. I have a good tenant who's going to have pride of ownership in the property, take better care of it, and then we close this thing next year. It just doesn't happen. It's primarily, I'm not going to say that they never close and there's never a seller landlord out there with good intentions. For the most part, these are things that are done by sellers, aka landlords, to maximize their yield
Absolutely.
on their property.
Yeah, and you said it. I mean, the downside, you typically see lease to owns in markets that are declining more so than in markets that are appreciating. I mean, in most markets, you're not going to see those lease to owns at this time, right? I mean, I have people contact me probably a couple times a year. Can you find me one of these? The answer is no. I mean, they're just not out there because, why would a seller tie up for a couple of years when they could just put the home on the market, probably get multiple offers and sell for more than it's worth anyway? But yeah, anyway, let's move on here.
So actually, here I inadvertently insulted Michael, so I apologize, Michael. I was defending the beauty of my curls, which Jennifer already did for me in the chat. Jeb failed to catch that part, but we missed a more important comment from Michael way early, and I can't scroll that far enough to get back to it. He talked to our friend Randy Teakle, who happened to only be about 20 miles down the road from him. So Michael's out in Texas, and he didn't. Michael. Chat comment there if you want, but you weren't in a bad situation. You had talked to a lender that you liked, but our buddy Randy out there is awesome also. So wherever you're at, Jeb and I have a big network. We can get you connected with someone who'll do a great job, even if it's as simple as just reviewing your numbers and saying, hey, you're in good hands. Like I said, I talked to someone out in Lancaster today, was working with another lender, and they had good terms. We could have done a little better, but certainly not enough to start over in the transaction. So they have the peace of mind of knowing, yeah, I got a good deal.
No, good stuff. And that link is in the description below. If you want to hit it, again, it will automatically refer you to somebody that we know, like, and trust that does a good job. And again, there's no benefit here other than the fact that you're getting connected to somebody that's a pro, right? Nicole has a good question for you, Josh. Schedule C income for over 5 years. 2020, not as good as 2021. Can I still use 1 year? The problem is I also have a Schedule E, so I'll have to show the last 2 years for the rental unit, I believe.
So it's all going to come down to the automated findings. So if the business has been in existence, so Nicole's watched for a while. Business has been in existence for longer than 5 years. So Freddie Mac guidelines say the power's going out. That's what Freddie Mac says. Freddie Mac says pay the electric bill. So Freddie Mac says if you've been in business for more than 5 years, 1 year tax return. So the Schedule E, that wouldn't necessarily say that you need 2 years, but it comes down to the automated. The automated is going to come back and tell us, do they want 1 or 2? So I can't give you a direct answer. We would need an application and a credit report, run it through the system and tell you. But here's the thing. Are you just trying to avoid having to explain why 2020? Oh, I got it backwards. I thought you were saying 2020 was the downturn year. I was reading 2021 as 2019, thinking you had a good 2019, a downturn in 2020. But yeah, if 2021 was better than 2020, we should, in your situation, be able to get away with 1 year, especially with a higher range credit score. So hopefully that helped.
No, awesome. And what was I going to say? Oh, I'm over here clicking through emails, people. This is completely off subject because I just renewed my license with the Department of Real Estate here in California. So you got 4 more years of this at least because I'm going to be selling real estate.
They can revoke it. They could.
They could. Although I haven't done anything yet to get there. But I might soon if it keeps up. But what I was going at here, I was deleting emails because they sell your damn email to everybody on the planet. So once I renewed it, I changed the email that was in the system. That was a huge no-no, because now all of these dummies out there have my new email or the new email that I used and just sent. Like I get so much junk now from this crap. So just, just stick to an old junk email when you sign up for things. That's where I'm going. It has nothing to do with housing. Sorry, guys. We're going to move along here. I'm just, I told you, we might just use this channel to gripe about things that,
Jeb,
happens in life.
As a computer science major, I would expect you to know that with Gmail, you can put junk plus your actual email address, and that way they don't have your real email address, and you can just set up a filter for that to just automatically throw anything that you call junk in the trash.
Bro, mind blown. No idea.
Yeah,
no idea.
I'll show you lots of things.
Wow, look at that. Just mind blown. I didn't know you could do that.
I used to read a lot of Lifehacker back in the day.
Dude, that's a good one. I like it. Junk plus my email equals my email, but I can make a junk folder for it.
Any word you want. You could put a-hole plus Jeb at Jeb Smith, and it will come in. You'll still get it, but you can filter it by that email and make it do whatever you want.
Wow. All right, here we go, guys. And I am a computer science major that's never done anything with my degree, by the way.
Hey, Jeb, I have a question over here that we've never seen on the show, and I would love to hear your input on it.
Oh, God.
Lizardan, so it's like a lizard and Dan all in one, says, is buying a house you've only seen on video a good idea?
Ooh, there was another question that went along with that. It took me a minute to actually understand what that meant. And we are going to answer it, but there was another one here that talked about buying in San Diego a moment ago. And she asked, it was a female, Julie. Here we go. Julie, I'm moving to San Diego in December. Should I remotely buy a house in San Diego now with a video tour only, or should I wait until I move there in December this year? So that's going to be one of those situations, to each his own. I've sold several properties in my career to who are now clients of people that never saw the property. From virtual tour, me walking through it, the virtual tour online, to photos, never saw the property until they closed on it. Some have actually gone into contract and then seen the property after the fact, because we did all of it through video. So I would say it's, that's something that you have to be comfortable with. There's going to be a large majority of the population out there, home buying population, that aren't going to be comfortable with buying something like a house, huge financial piece of the puzzle there, without actually seeing it, being able to touch it, look at it, so on and so forth. So you got to know what you're comfortable with. If you do decide to do that, make sure you have an agent, though, that is truly there for your best interest, that is willing to walk through and point out things in that property that are negative, if assuming that there are, when they're walking through it, and not showing you just the highlights there to get you to buy a house, right? I mean, no agent should be avoiding things in any situation, whether they're showing it in person or not. But I'm the type of agent, when I walk through a property, it could be our first time, could be our 10th time, I'm pointing out a lot of the negatives. I'm pointing out the major things in the home, for one, right? Like the HVAC. We're looking at, water heater. We're talking about, the roof, the furnace, that sort of thing. My opinion on it based on experience, right? I'm trying to get you the age and give you my thoughts on things they've done. But I'm also pointing at things like, hey, see here, the baseboards, they were never caulked on the top. Whoever did this, the corners that sort of thing, because a lot of buyers are in it. Again, it's an emotional process, but they justify logically. So they're not there nitpicking properties. They're there primarily to see, hey, does my furniture fit? Do I like the neighborhood? That sort of thing, which is okay. But you just need to understand that, there might be some things that aren't correct with that property. And so if you have an agent that's willing to do that and is doing that, then you probably have a good agent, and it's okay to buy, but you need to make sure that you've seen it in the best light possible, right? So, maybe at night, during the day, that sort of thing, just to get a good view of what it looks like, and maybe have somebody do an actual video of it and send it to you, so that you can, watch it on your own time at your own pace. I would say there's a right or wrong answer here. It's just what you're comfortable with. So,
well, one of the things that's funny about this, Jeb, this is largely generational. So both Julie and Lizard Dan were millennials. You can tell from looking at them. And millennials are much more comfortable with the idea than some of us older folks. I'm a Gen Xer. You are a senior. Are you a senior millennial? Is that your story?
Yeah, I tried to use that one day, bro, and people got all over me. They were like, I said I was an older millennial based on like the new thing that came out. And they were like, oh, you're trying to make yourself a millennial. Like, no, I'm not. I'm reading what I said. And then so I don't know what I am, bro. I'm like I have no idea. I don't know where I fit on the schedule. I'm 80. I'm born in 80.
Where I was going with that is, as a Gen Xer and a senior citizen millennial, I don't think I would ever be comfortable with that. But it could just be a personality thing. But I do know that in general, your numbers, millennials are more comfortable with the idea. So if they're going to do it, all of that advice you gave is great. But it's definitely something that younger buyers are more comfortable with.
No, good stuff. Clintus. I have no idea. But anyway, thank you for the
German.
Clintus.
Clintus.
That was good. But anyway, thank you for the super chat. I'm going to make Josh answer this and keep the money. If I rent out my personal residence after a year of owning it and buy another residence and rent it out after a year and keep doing that over and over again, does that reflect negatively on them as a potential borrower, Josh? Does the lender look at that negatively?
Not really, because you're not doing anything wrong. You could document it. Let's say you had done it 4 times, and the 5th lender comes back and goes, "No, this is wrong. Clinthouse is gaming the system." I'd say, get me your last 12 electric bills, your cell bills showing that they went to this address, and I'm going to go to the underwriter and say, "This is not your call." When you get an owner-occupied loan, you are not telling them that you are going to live in the property for the rest of your life or for any specific period. What you are doing is saying, I intend to occupy this property as my primary residence within 60 days of closing. So it's up to any lender. If they're not comfortable with it, they don't have to make the loan to you. I'm telling you, we can find you a lender that would keep doing that for longer than you would be willing to, or able to buy homes. So if you can pull it off every year, I wouldn't hesitate to do it. I would debate or argue that with an underwriter 8 days a week, because again, you're not doing anything wrong. It's not anything outside of the guidelines. It's just making use of a loophole to get owner-occupied financing on multiple properties.
No, absolutely. Jennifer is our moderator in the chat. She will kick you out if you don't like and subscribe to the channel. So do me a favor, if you haven't done so already, hit the like button. We appreciate Jennifer being here. I told you last week I sent Jennifer a little gift. So I sent her ice cream from Jenny's ice cream in the mail. I think it was like 5 containers of ice cream. So she had messaged earlier in the chat basically saying that I should treat my wife, and I did the zip mouth, like basically like keep quiet, because I was going to say that I treat my wife, but then it wasn't going to be appropriate for the channel, so I zipped it. So it wasn't related to you, Jennifer. It was I was keeping myself from saying something that shouldn't be said. Anyhow, but thank you for being here, and one person liked after I said that. So thank you for the one person who did that.
Well, Stacy thinks you are a millennial. So that tells me a lot about you, Jeb.
Oh, wow.
You are a millennial. Quickly jump through this one, Jeb, because we answer this about every other week. It comes up a lot. Kenny Lopez says, I'm an escrow on a property in Santa Ana that had multiple offers. Inspector says $10K worth of work to get the home up to code. Should I ask for the credit in this hot market?
Absolutely. You always ask for the credit. Ask for the credit. More importantly, I would probably ask for the repairs to be completed, is how I would approach it. I'm not giving you advice, but if you were my client, I would say either come up with a number that's higher than what it actually cost, for one, and or come up with the list of massive repairs that it's going to cost to fix it. Because a lot of times sellers will overestimate the cost to do these repairs and actually give you more money than you need. In some cases, you might not get anything. Let's be honest. I mean, you're in a market that is competitive, but it's still okay to ask for a credit of some of these things. Even if you've agreed to an as-is offer, ask for stuff, right? The worst thing they can say is no, and then you can make the decision whether or not you want to move forward, right? Just because they say no doesn't mean the contract falls apart. Just means that there's a negotiation, right? And some people aren't comfortable with negotiating. So that's why you have an agent that is comfortable with negotiating and trying to come to a conclusion. But the easy answer here is yes, absolutely. In any market, ask for it and see how it comes back to you. But have some something to back up your request there, just so that they know you're not, you didn't offer X amount for this house and now you're trying to scramble and get a deal. It's like, no, these are legit issues that need to be addressed. And whether they're from me or another buyer, you're going to have to disclose them. And it's something that needs to be corrected. And so while you might find somebody that's willing to do it, are they willing to do it at the price that I'm already in escrow at? And, how long is it going to take that seller to go back on the market, find a new buyer, so on and so forth? And
Jeb,
yeah,
Jeb, I was going to say something important, really important that you said is, as a seller, I can put my house on the market and claim to be unaware of almost anything in my home. Once I sell it or put it under contract and you get an inspection done and the inspection comes back and I have a copy of it, I can't claim that I don't know that to any future buyer. So it's known, it's on the table, it has to be disclosed to any future buyer. So it's not like it goes away. The risk they would be taking is saying, I don't want to pay it, and someone will accept this if you won't. In this situation, they have to disclose it to any other buyers going forward.
Yeah, no, agreed. Here, we got some good questions here. Let's see here. This one is just coming to mind here. So, I mean, I'm going to throw it up here, and then Josh, you can try to find one that there's a couple there right before it. Why does it seem like realtors are in the way when talking with a new construction builder? Because typically, I mean, honestly, with new construction as agents, there's not really a lot for us to really do, at that initial meeting of walking through the property. It's a matter of whether or not you want to purchase it. Where us as agents can perform is, when that new construction, when you decide that you want to make an offer and you're actually working with them to figure out a price and what have you. I've negotiated several new construction deals where the builder gave us credits towards the building center, where just things to ask for that the buyer wasn't aware of because they didn't know that the builder would negotiate any of that stuff or work with them in any way. Now, market's a little bit different right now just because of where things are, but you're still going to have, if you've been following this show, even on new construction, I recommend you do a home inspection. And so, that an agent can help you work with the builder to get that stuff completed prior to closing, right? You can delay closing if that stuff's not done. Whereas a buyer not having any representation other than the builder, you might feel like you're forced to be able to do, have to do something because you don't know any better. You don't have anyone there to guide you. So while it might seem like agents are in the way, in some ways they can be, because a lot of that back and forth of submitting an offer, wait for it to come back to you, and all of that isn't part of the negotiation. In most cases, it's like, hey, the builder is saying this is what it is. Do you want to pay it? Yes or no? And then it's a matter of filling out the paperwork. So a lot of that upfront negotiation's gone, but I would say it's still worth it to have an agent. And at the end of the day, it's not costing you anything to do it, right? The builder is paying for your agent. So, it's better to have the representation than not.
I would go back to just the simple thing is, a realtor on new construction is going to do far less than they do on a standard transaction for you. But when you get presented with a 120-page contract, unless you're a contract lawyer who deals with that stuff regularly or someone who negotiates for a living, you're probably going to be better off with an expert on that. Now, I don't mean, again, your cousin who just got his license, don't take him in there so he can get the commission. It's someone that's actually going to read through that stuff, walk you through it, answer your questions, and cover your butt.
No, good stuff. Here's a quick question, Josh, to answer. Is Jimmy, also a regular viewer here, is population growth and poverty rate important when searching for a home? Yeah, go ahead. I have my thoughts on all this, but
more people in an area is more demand for housing if they're able to buy the homes that are priced in that area. So imagine San Francisco Bay Area, if a bunch of we take people that are illegally crossing the border in Texas, run them into the Bay Area where they have a $1.2 million entry price point. That's not going to improve the home prices. It's going to make it worse. But other things being equal, more people in an area, if they can afford the homes, there's a finite supply of homes. It's going to decrease or increase the prices just due to supply and demand. The poverty rate, it's an interesting one, because think about this. We have really high rates of poverty in parts of Manhattan that have the highest home values in the United States. Other areas, urban areas, have high levels of poverty, but also high levels of income and wealth that keep prices higher. Where were you going with that one, Jeb?
Well, yeah, I mean, I would say, like, if it, when you hear me talk about investing in property and some of these areas, look for areas that are growing, right? Where jobs are coming in, where the city is expanding and that sort of thing, because it's going to add value, right? It's going to add demand to the market, which in theory is going to increase the supply, the value of the supply that's there. So yes, I think it's important. Poverty rates, like Josh said, can or cannot impact a market just depending on, where it's concentrated in a market. For example, take LA, right? Downtown LA, you have high-rise condos that are selling at premiums, but yet just below them on the streets. I was there just this past weekend, Skid Row, and Skid Row used to be like a row, like a block of tents and homeless and whatever. It encompasses the entire city now. It's bad. It's a big problem. And so in that, is it affecting it? Yeah, maybe not. But take, for example, Venice Beach. Venice Beach, another spot in LA. You've got people homeless that have taken over the beach. They have set up tents on the beach in front of multi-million-dollar homes, which look out over this area, and now they have to look out over tents to see the ocean. That is affecting those homes, right? Because there are people that don't want to buy there because they don't know if and when the city's going to be able to clean it up. And so in that case, it becomes more of a problem because you're literally staring at it out of your home. Whereas something like Manhattan and LA, yeah, when you're down there, you're kind of in the mix, but once you're in your property, it's foreign to you to some extent. So I would focus more on city growth, right? Especially if you're buying in an area that doesn't have a large population. What companies are coming there? How is the city going to continue to expand so that you can continue to get that appreciation over the years to come?
Hey, we got a good follow-up here. So yep. Alex says, awesome question, Clintus, who was asking about how often.
It's not Clintus, bro.
Clintus. Clinthouse. I thought I would have to wait 6 months before moving after my refi. So Alex, here's the issue. If you just refinance and said, I'm going to own or occupy, we have to have a very good reason to explain to the underwriter what the hell changed. If we go back 3 months later and go, yeah, I know 3 months ago I said I was going to live in that one, but now I want to live in this one. Did a parent pass away and you're financing the property to buy out your spouses? You didn't know that was your siblings, and you didn't know that was going to come up. I had one earlier this year that we had a really crazy case. We closed 45 days after an owner-occupied refi on an owner-occupied purchase. It was a long and detailed explanation. So talk to an expert, talk to someone that knows what they're doing, and come up with a really good reason why you're moving in less than 6 months and using another owner-occupied loan after your refi. Jeb, we have one of my favorite questions.
Well, I'm gonna throw. Maybe this was it. I don't know, but we're gonna throw this one up here real quick. In your opinion, has the value of land in California increased as dramatically as the value of homes this past few years? My husband has been pressuring me to build. So that's a tough question to answer. The value of land has clearly increased. I don't know if it's increased at the same level of property value. I mean, as homes that have property on it. Josh can probably give you more detail on that exact answer. But what I can tell you is I have a lot of people reach out to me thinking, hey, I want to buy a lot and I want to build a house. And what I can tell you is it's typically a lot less expensive just to find a house that's already built on the lot in this environment, just because, for one, it's hard to find the land here in California, depending on where you are. And secondly, to build a home right now, what you're plan, you might be praying too, but what you're paying per square foot to build is insane just because of where the market has gone. And then you got to find somebody that's willing to do it, hold to the timelines. There's a lot that goes into it. Now, if you're in a less dense area, you're maybe out in more rural, it might be a little bit different, but prices to land values? Josh, do you know the correlation? You know,
it all land is not the same. So like you're talking about density, coastal, developed California, those prices, the land prices are the only thing that's driving that. Yes, construction costs have gone up, but look at the tax bill. We've talked about this before. If someone buys a home in my neighborhood at $1.5 million, it says the structure value is like 300,000, the land value is 1.2. All of that growth is in the land value. And I guess the flip side that I would say is, if you've ever been to like Pahrump, Nevada for any reason in your life, you'll see signs of land available basically for free because it's dirt and rocks and no one cares. So that's Nevada, but we've got areas like Barstow in California, other areas up, out to 15 where land is virtually worthless. So I'm certain you're not wanting to build a home in rural Barstow.
Santa Cruz, baby.
So Santa Cruz, if you have a piece of land, absolutely build on it, improve it. But if you're looking to buy land in Santa Cruz, it's gone through the roof. Coastal California, the land is what drives the prices.
She said she came back and said my parents have land in Pahrump. They got swindled.
Yes, they did, and I don't even know what they paid.
That's classic. They're paying the taxes on it every month.
Yeah.
Too funny. In fact, I sold a lot a couple of years ago in Huntington Beach in an area that's considered a flood zone.
In my neighborhood.
It's not in your neighborhood, but kind of by your neighborhood. Still not built on. But at the time, what I got for that land was substantially higher than anybody thought it was worth, including myself at the time. And assuming I don't know where they are, if they're trying to build or what they're trying to do there. That guy looks like a genius at the moment that bought it. But yeah, it was a big lot in a cul-de-sac, and there are restrictions in building in a flood zone, especially here in Huntington, in a 100-year flood zone, and or flood A rather. I guess it's on a map, but that's a whole different conversation. We could talk about that later. But we're pushing 2 hours, Josh. Anything that you want to talk about here at the end?
Answer my favorite question, bro.
All right, let's see.
Lizard Dan comes back with questions.
I almost hit it.
Good question number 2 here. Say I bought at 2.8 interest and interest goes to 2.7. Is it worth refinancing? How much of a gap when I should refi? He got a bunch of answers over here, and none of them are terribly wrong. We got actually a lot of good answers, but they're not as simple. Most of the answers he got said no, not enough of a change.
That was my answer. No, it doesn't make sense.
So look at it. It depends on the size of the loan. So most likely, no. We have a simple rule of thumb. Take $125,000, divide it by your loan amount. It's going to tell you how much you need to save. So if you have a $500,000 loan, take 125,000 divided by 500,000. It tells you need 0.25% savings. This is 0.1 savings. It's 40% of what you would need to save to make it worthwhile. Now, if you had $1 million loan, 125,000 divided by $1 million, you're right there where it becomes worthwhile. You still have the headaches and the hassle of providing documentation, signing docs, all that fun stuff. So you'd have to decide, but it varies by a loan size. We've had people call in and say, hey, I got a $60,000 loan at 5.5%. I have to refi, but no one wants to do it for me. Because you look at it when you pencil out the costs, even a 3% savings in interest on a $50,000 loan is hard to justify.
No, absolutely. So before you answered your favorite question, I was going to ask you if you had anything last, that you wanted to end with here. As always, we appreciate you being here, right? We spend 2 hours doing this, to help provide clarity, to provide education, to guide you guys, whether it's real estate or mortgage, provide some insight, as somebody who's actually out there doing this stuff, right? Not a talking head, so to speak, and that we have no interest in what we're talking about. These are things that Josh and I are doing daily, and we do appreciate you guys being here. So, Josh.
Nothing final, but these guys are coming in right at the gun here, right at the wire with some good questions. You want me to? I got one here I do want to answer because I think there's a lot of people that don't want to ask it. Arrowette Figueroa says, I'm on a forbearance plan. Can I refinance my home when I owe a lot on it? So as soon as you have made 3 payments out of forbearance, you can refinance. His second question, when I owe a lot on it, doesn't really matter. It comes down to, do you qualify for the loan? Does your income allow you to qualify? Does the home appraisal support it? But for any of you who were on a forbearance plan, you can refinance after forbearance. It's a little bit more complicated. It's important that you work with someone that's familiar with it, but we do a couple of them a month right now. So absolutely you can.
Now, again, I mean, hey guys, put in the comments here. Maybe, we can ask the question, or maybe I can do it next week. I know I can do a survey if it makes more sense to do this from 6 to 8 versus 5 to 7, right? I mean, I don't know. I don't know if Josh and I, quite frankly, want to sit here from 6 to 8.
I'm ordering wings if you do it from 6 to 8. Wings and beer.
Can we charge the viewers for that?
Admission $1 a head on the way in, and it covers wings and beer.
It could get fun. It could get fun if we did that. Yeah, we got a lot of good questions here. If your question isn't answered, if you want to reach out to Josh and I directly, we're happy to address a lot of those. I'm going to throw Josh and I's information up here at the bottom. As always, guys, I appreciate you being here. If you haven't done so, if you enjoyed anything, if you got anything out of this at all, hit the like button, share it with a friend that's looking to purchase. If you need a contact, if you need a mortgage lender, if you need a real estate agent anywhere in the country, reach out to us. Again, we network with a lot of these. In fact, Josh is going to network with a lot of mortgage pros starting tomorrow. In fact, a lot of that you guys have probably been referred to some extent. So we're always connecting and talking to these people, and happy to put you in touch with one of them. There's a link in the description below if you want to get referred. But I appreciate you being here. Josh, final words, parting words.
Patrick says he's in. He'll have his wings and beer ready too. So next week, let's do it.
All right. Well, maybe change it up. We'll see what happens. All right. But then it won't rhyme. Live at 5, live at 6.
In the mix at 6.
In the mix at 6. Look at that. Adios, compadres.
See you guys.